That's clearly a breakout. I would think silver's going to go at least to 50 and test that. I don't think longer term 50 is going to hold. I mean, we're going to go above 50, and then who knows what kind of numbers. And gold, I mean, there is no technical area or number, because we're at all-time highs at this point, and just have to see where the next battle. The reason gold, and of course silver too, silver has been suppressed because they didn't want the fuse on gold lit. And they don't want the fuse on gold lit because if you've got $25,000, $50,000, $100,000+ per ounce for gold, that shows no confidence or a lack of confidence in the paper. On the other side of that, their confidence is absolutely needed in order for the U.S. Treasury to borrow the ridiculous sums that we've been borrowing.
For decades, gold and silver prices were suppressed to protect the dollar, but with soaring debt, that suppression is failing. The market is finally reflecting what a collapse of trust truly looks like, with gold at all-time highs and silver expected to break past $50. Japanese bond yields are quietly unraveling the global carry trade, creating a giant margin call as investors liquidate long positions. As capital shifts out of sovereign bonds, gold priced in yen is revealing the truth. A similar carry trade unwind last year triggered a 25% stock market plunge in 24 hours, and this time, the breakdown is real. Global financial expert Bill Holter emphasizes that the surge in gold and silver prices indicates a decline in the purchasing power of fiat currency. The verdict on what constitutes real wealth is now clear. The timing makes the move even more striking. September usually brings thin books, risk reduction, and liquidity stress that weigh on metals. Equities have sagged, bonds have buckled, yet gold has stood tall. The seasonal script has been torn up because structural buying has rewritten the plot. In a paper market built on IOUs, investors are quietly demanding physical delivery of silver, exposing the Achilles heel of the fractional reserve system. As major sovereigns sell treasuries to buy gold and silver, the dam is breaking, and a failure to deliver could trigger a global stampede into physical metals. The Silver Institute and Metals Focus both forecast that this market will experience its fifth consecutive year of undersupply. Since the end of May, Bloomberg-tracked silver ETFs have experienced inflows totaling almost 2,100 tons. Concurrently, Bill Holter notes that discussions of a gold revaluation are a signal of government's desperation to reflate the system. Following Richard Russell's dictum of inflate or die, inflation is the only choice. This guarantees higher precious metal prices ahead. Before we dive into Bill Holter's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
Front and center for me right now are the Japanese 10 and 30-year interest rates, and along with that, the yen itself. Literally trillions of dollars were generated by borrowing in yen. It's the carry trade. It's really what blew the Western bubble through the roof. It created capital to afford, buying of all kinds of assets. They were borrowing for years at what? Call it 0.25%, and now on the 10-year we're up to 1.6, and on the 30-year we're up to 3.2. You've got it blows it up, because if you're borrowing at 0.25%, that's what your model shows, and then all of a sudden you wake up and you're now paying 1.2%, and if you've got a stronger yen at the same time, it blows that trade up, which causes margin calls, and if you close the borrow side, you've also got to close the long side. So it could be really disruptive. And oddly enough, well, maybe not oddly enough, but if you overlay a chart of gold with the Japanese bond market, gold and the Japanese yields, or the inverted prices, if you will, they seem to be going in lockstep.
Yeah, so
and both are going high. I think it's a breakout. yeah, it's clearly a breakout. I would think silver's going to go at least to 50 and test that. I don't think longer term 50 is going to hold. I mean, we're going to go above 50, and then who knows what kind of numbers. And gold, I mean, there is no technical area or number because we're at all-time highs at this point, and just have to see where the next battle begins. But this is a breakout, and I view this as a worldwide vote of no confidence in paper. Yeah, I would think if the dollar should be bouncing and bouncing pretty hard right now, it's not. And what won't go up must go down. So I think there's another leg down. But again, I don't think the DXY is really a good index to look at because you're looking at dollars versus other paper currencies, the euro, the yen. The true measure is versus gold and silver. And that verdict is already in. They took everybody's gold and they revalued it to $35. And that, there's a lesson to be had there. When they revalued gold from $20.67 to $35 to break the back of deflation, it was an inflationary event. And I mean, there's all kinds of talk wherever you look now about a gold revaluation worldwide. Well, what is that telling you? It tells you that they're desperately trying to reflate the system. And they have to reflate the system because of the amount of debt that's outstanding. And it all goes back to the late, great Richard Russell, inflate or die. I mean, in this system, we cannot have deflation. You cannot have deflation of assets because everything is held up on margin. And when assets deflate, you get a margin call, then the entire system comes down, and basically currencies become literally worthless because they're based on the full faith and credit of the issuer. And all of these issuers, from the United States to all the Eurozone, I mean, they're all bankrupt. They're all upside down and insolvent. You're going to have more and more people buy contracts and then immediately stand for delivery. As a matter of fact, for the last 2 or 3 years now, it used to be, and I'll use silver as an example, it used to be that there were X amount of contracts standing for delivery on first notice day. And then by the time delivery day came, final notice day, the amount of contracts outstanding would have dwindled by 50% or more. Over the last 2 or 3 years, what has happened is you get X amount of contracts on first notice day, and then by the time of the last day, final notice comes, there's more contracts outstanding. And in some cases, there's more than double or triple the amount of contracts that were standing the first day. So you have buyers that have been coming in and immediately standing for delivery. And that's the Achilles heel to the fractional reserve system. I mean, there's no question. I mean, even the powers that be will admit, yes, it's a fractional reserve system. We really only have 5% or 10% of the metal or whatever it is available for delivery because not everybody stands for delivery. Well, we're at the point now where there's more and more understanding that because it's fractional reserve in nature, it will ultimately fail to deliver. And again, the psychology of human beings, when they're told they can't have something or they might not be able to have something, they want it even more. And it's going to cause a stampede of contracts standing for delivery, and that'll be your failure to deliver, which blows up the entire system, by the way. Because if you've got all these contracts that are actually worth zero because they cannot perform, the reason gold and of course silver too, silver has been suppressed because they didn't want the fuse on gold lit. And they don't want the fuse on gold lit because if you've got $25,000, $50,000, $100,000+ per ounce for gold, that shows no confidence or a lack of confidence in the paper. On the other side of that, their confidence is absolutely needed in order for the U.S. Treasury to borrow the ridiculous sums that we've been borrowing. I mean, we have to borrow $2 trillion a year just to balance the books, just to keep the system afloat. So they suppress price of gold and then whack it. I mean, you remember, go back, 10 years ago, 15, even 20, 25 years ago, gold would start to pop its head up and then whack it, 1, 2, 3%, which back then when gold was $300, $400, a $10 move in gold was huge. And it was demoralizing to see all of a sudden gold was going higher and boom, they smashed it. Well, the reason they smashed it was because they want to be able to point at the price of gold and say, see, gold bad, dollar good. And that allowed the confidence for the rest of the world to buy treasuries and fund the U.S. deficit. At this point, that's starting to unravel because you're seeing some very big sovereigns liquidating U.S. treasuries and turning around and replacing that with either gold or silver.
A significant disconnect is occurring in the precious metals market. While North American retail demand has collapsed, with people selling for cash and signaling money on the streets is drying up, hedge funds and family offices are quietly accumulating physical gold and silver. With its historic 15-to-1 gold to silver ratio now at 85-to-1, even a partial reversion would send its price to well over 100 per ounce. Meanwhile, supply remains inelastic, with no major discoveries in over a decade. Silver's role in the clean energy transition and its growing strategic importance in BRICS financial systems position it as a cornerstone of the 21st century economy. With industrial demand projected to grow by 50% by 2030 and supply constraints persisting, the bull case for silver is both robust and enduring. Silver prices have enjoyed a merry run in the last few weeks, which has seen the precious metal overtake gold in terms of gains. However, analysts expect silver's outperformance relative to gold is likely to end in the coming weeks. According to Holter, Fed rate cuts aren't about a weak economy. They're about an unsustainable debt load. The Fed needs lower rates to keep interest expenses from collapsing the system, and that same debt dynamic is a bullish driver for gold and silver. Let's get back to the interview.
Metals don't change. An ounce of gold is an ounce of gold, and an ounce of silver is an ounce of silver. Whether it be today, 100 years from now, or 100 years ago, it's still the same 1 ounce. What's different is the currency and how much that currency will purchase. And you're using the number 3,500 for gold. In 1971, gold was pegged at $35. So what does that tell you? It tells you the dollar since 1991 or 1971 has lost 99% of its value, of its purchasing power.
Yeah,
and that's just
that
math.
Retains, it's what the dollar today is 1/1000th of the dollar that it was back then.
It's 1/100th.
You're right. Sorry.
It's 1/100, 35 to 3,500.
Yeah.
And this has been going on. It's been going on and on and on. We've had a bull market, if you will, in gold. But the reality is it's been a bear market. It's been a diluting market in the dollar and other currencies ever since we went off the gold standard. A lot of hedge funds and family offices, they're knowledgeable. Not all of them, but a lot of them have been buying the physical metal.
I see.
Now, that said, I can say that for the last 9 months, even close to a year, the demand for physical metal out of North America has collapsed. But yet the price of gold, if you asked me 5 years ago or 10 years ago, is there any way gold could run from 2,700 to 3,500 and North America be a net seller? I would have said no way, because it would stir up the greed factor. But what you're seeing is liquidations out of North America, and whatever. I've gotten more sell orders in the last 9 months than I had cumulatively in the last 15 years. And I asked people, why are you selling? And I've only had maybe a couple, 3 people tell me, well, I'm going to take a profit. And I asked them, well, where are you going to put the money in a system that's going to mathematically collapse? to keep it protected. And they're like, oh, well, when gold drops or silver drops, I'll go back in and I'll rebuy it. Well, good luck with that, because when there's a failure to deliver, there won't be anything to be had. And if you're not on the bus, you're off the bus and you can't get back on the bus. But the vast majority of people that I've asked have all said, I need the money. I need it to live on. So it tells me that the money on the streets in North America is evaporating or evaporated. I mean, think about silver. Think about all the uses that silver has: medicinal, industrial, technological, monetary. I mean, there's so many uses for silver, and it is, in my opinion, silver is the most underpriced asset on the planet. Danny, I say that because gold, the reality is gold is the measuring stick. We got fooled. The world got fooled for 50 years that the measuring or more, that the measuring stick was the dollar. Everything was measured against the dollar. How many dollars? The reality is dollars themselves are measured against the ultimate measuring stick, which is gold. The reason I say silver is the most undervalued asset on the planet, I mean, for how many hundreds of years, and even in the U.S. Constitution, the ratio is 15 or 16 to 1. You could go back 1,000. Well, first off, silver comes out of the ground just under 10 to 1 to gold. So there's roughly 10 ounces of gold pulled out of the earth for every 1 ounce of gold.
1 ounce of silver.
That's God's ratio. 10 ounces of silver for every 1 ounce of gold. Now, for hundreds of years, the price ratio was 16 to 1. And the reason being, back 100, 200, 300, 500 years ago, in order to transport money, you had to transport gold or silver. But if you transported silver, you had to transport 10 times the amount of silver to get the same capital. So man discounted the silver price to 15, 16 to 1 to account for, the extra carts or carriages or whatever that you needed to transport silver. So that 15-16 ratio, 15 to 1, 16 to 1, went for hundreds of years. And in today's world, now we're back down to 85 to 1. We were as high as 120 to 1. 120 ounces of silver, that's undervalued by 12-fold. And where we are now, it's undervalued by what? 6 or 7-fold. Yeah, we're right at the end game. It could happen any month. It could happen in gold. It could happen in silver. I've always thought that it would happen in silver just because it's such a small market. And I mean, if you came up with 25 billion, you'd buy every single ounce produced on the planet. It's so small in relation to all other markets. I mean, it could be platinum. It doesn't have to be a metal. It could be a grain. It could be anything. Once there's a failure to deliver and people understand that, confidence is broken before their eyes, it leads to the next market and next market and the next market like a wildfire. Well, it spells higher prices. It spells lower currencies, but understand the thought process behind, we need much lower interest rates. Well, supposedly the economy just grew by 3%, right? Last quarter,
right?
Which I don't believe it at all, but that's a strong quarter. So why would you have to cut? The real reason they have to cut, they want interest rates lower because they've got literally trillions that are coming due to be rolled over, along with the additional 1.5 or 2 trillion per year that we have to borrow. The interest expense now is what, 1.5 trillion per year, on its way to 2, 3, 5, who knows what the number is going to be. In order to keep the interest expense down, they have to get interest rates down so that all this boondoggle of debt can be refinanced.
Companies with exposure to Russian or Chinese silver markets, such as those involved in yuan-ruble trade or BRICS infrastructure projects, could benefit from regional demand growth. The gold and silver breakout is a global vote of no confidence in paper assets. Will investors recognize this turning point early enough to secure real assets, Or will they wait until the paper system breaks and discover it's already too late? Drop your thoughts in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.